So the first point, the first attribute is robust returns over time, both in absolute and in relative terms. And I think that that's where there is strong evidence to show that short volatility does perform. It does post positive returns over time in different asset classes and in different regional markets. The second one is the rationale behind the strategy. And here, people typically split the rationale into three buckets. So there's a risk-based explanation, which is really the strongest form you can have. So you take a risk, you're compensated for taking that risk. Clearly, that is the case for short volatility. You then have behavioral explanations, which I think can apply to short volatility as well. Thirdly, you have structural reasons for the existence of the premium. So in this case, we're looking at supply-demand imbalances. We are looking at things like regulatory changes in the markets, which might drive that premium. Again, I think that that's something that does apply to short volatility. Thirdly, there's the question of diversification. So this is probably a point where investors have to be aware of the risks to the strategy and the fact that short volatility does not necessarily give you diversification when you really need it. So when there are large drawdowns in other asset classes, traditional asset classes, in particular in equities, that's where short volatility typically underperforms. And that's something that is a reason for there being a premium in the first place, but it is something that you have to bear in mind from a governance and risk management perspective. So for short volatility strategies, first of all, we do have a reasonable amount of data showing the historical returns of short volatility in different asset markets, in different regional markets. And there is quite a persistent spread between essentially implied volatility and realized volatility in different markets over time. And we can see that there's some academic research which demonstrates that. I think one fascinating piece of evidence is that there are some studies which go back all the way to the 1800s, and they demonstrate that what we understand about the equity derivatives markets today, equity options markets today, some of those features are pretty much the same as they were back in the 1870s, 100 years before anyone knew about Black-Scholes and pricing options the correct way. So you could argue that the patterns we see, and in particular the implied realized volatility spread that we are trying to capture, is a very persistent feature in the markets. Now, the second point, the rationale for the strategy. So again, I think that's where short volatility is doing pretty well, because the way I look at strategies overall, I think there are three key drivers, three key rationale that you can come up with. There's a kind of a risk-based explanation for a strategy. Essentially, you get paid a premium for taking a risk. Now, obviously, that is the case for short volatility. It is selling insurance, and that's where the return derives from. You also have behavioral explanations, which I think can be a plausible explanation for short volatility or performance of short volatility. And thirdly, you do have some structural elements. So things driven by temporary supply-demand imbalances in the markets. You have anomalies which might be induced by regulation. Now think about the post-financial crisis world. It's very clear that those structural reasons might exist. Now, the one part where I think short volatility may fall a little bit short of the optimum is on the diversification benefits. So what we do see is that clearly this is a strategy that can perform very well for extended periods of time, but when it doesn't perform, or where it posts negative performance, is often when everything else is posting negative performance. So it's not necessarily giving you diversification when you really need it, but it is, on the other hand, it is that feature that is creating the premium in the first place. That goes back to the risk-based explanation for there being a premium in short volatility. So I think on the whole, we should be a bit cautious about the diversification side of things, but in terms of the robustness of the strategy and the rationale behind the strategy, it's definitely one of the stronger ones out there in my view. And finally, on the point of implementation, I think that we have moved on a lot over the years, and thanks to the efforts of people like the good people at Cboe, it's a large liquid market, and there are things people can do. Capacity is there, liquidity is there. So I think that it's short volatility does tick that box as well. I believe this was my first time at the risk management conference, and I really enjoyed the day. It was very good panel of speakers, and very interesting takeaways. And I think there's a lot of things I want to follow up on later on. So really enjoyed it.